This is Trepp Wire with a guest podcast, The Economic Impact of COVID-19 on CRE Finance. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and joining us today is Adam Behlman, President of Real Estate Investing and Servicing Segment at Starwood Property Trust, the largest commercial mortgage REIT in the U.S. with a market cap of $5 billion and 350 employees. Adam, welcome.
Thanks. Thanks for having me.
Give us a quick overview of your background and what are the core business lines of your segment?
Oh, sure. So I have been in the securitization business since 1989-90. So really through the predominant part of it. I started off at Deloitte in their structuring unit, which was dealing with residential mortgage-backed securities. Predominantly, Freddie Mac was their biggest client, and from there, really learned about the business from the side of the debt side of really the structuring and analytical part of it. I got into learning about residential and then commercial real estate and asset backs at some point from the bond side, not from the being on the specific segment side of things. So it was a different approach I think a lot of people had coming into this business, especially into commercial mortgage-backed securities, where I say most people are real estate finance types more than they are structure, fixed income type of persons. So, I was very lucky. I had a great career at Deloitte. It brought me into working at Deutsche Bank for a good segment of my career. I worked on the CMBS desk. I was the head of structuring and analytics, which afforded me the ability to, not just, figure out what other people are doing, but really create new products. I was part of the innovation of the CDO market and things that went along with it, and was, really involved in pricing and structuring all the securitization business that they did. From there, I left. I worked at UBS, and we started off a new CMBS business there, and was there right when we started the Great Recession, and wound up actually running real estate finance for UBS during the downturn, which was, although insanity and crazy times, probably the most I learned about the business was over that period, because I inherited an enormously large both debt and equity book that it was my responsibility to exit out of over a 2.5 year period of time, and we actually did that right to the day that I no longer worked there. And then some of my good friends from Deutsche Bank wound up down at a company called L&R in Miami Beach, Florida, and I actually had 3 job offers: one in Des Moines, Iowa, one in Washington, D.C., and one in South Beach. And I turned to my wife, I said, pick one. She's like, kidding?
That's a no-brainer.
So wound up in Miami, amazingly. I came in as, again, like a capital markets kind of position, similar to where I started at UBS for their loan origination business. L&R at the time was the largest special servicer out there. They were one of the biggest B-piece buyers in the pre-recession era, were the largest. And from that, became one of the largest asset managers, because they had to work out all the different trusts that had issues, as Manus certainly knows very well, as we're probably on the phone every day discussing those issues. Anyway, so I wound up at a company that had gotten out of the investment side of the business, and that's kind of what my forte was. And as we wound up back in times, the company decided to put itself in the market, and lucky for myself and for the company, we got bought by the largest REIT that was out there, which was Starwood Property Trust. And they saw us as basically an opportunity to leverage great asset management, the ability to make all the fees that were going to come its way through being a special servicer, and additionally, an unbelievable level of expertise and data as far as what happened in 1.0 in the securitization market, which led to the resurgence of us becoming investors again. And really starting in 2013, when we got bought, we re-entered the market of buying B pieces. And, we've consistently been part of that universe. We do it differently, I think, than the 1.0 time. We do a lot of co-investing with other B-piece buyers. We'd like to, try to get in as many deals as possible to diversify our portfolio. We'd like to also have as many, third-party clients as we possibly can to try to build the book that we have if anything ever went wrong. And lo and behold, here we are again, where the markets have moved and we are now back into a situation where the special is going to become a predominant part of our business. And it certainly makes my job different that I'm now running, and really have been running what Eleanor was since 2015, moving from an investment company into an investment / special servicing company again. So, interesting time.
So tell us, Adam, in terms of the sleepless night count, how does this compare now to, your sleepless night count in 2007, 2008? How do you compare the two situations? More dramatic now, less dramatic? Give us the your sense of how bad it is now compared to the great financial crisis.
Totally different, and we're early on in this thing, so it's hard to say kind of how many more sleepless nights I'm going to be afforded here. Certainly, the month of March, or the second half of the month of March into the first half of the month of April was quite a sleepless period of time for me, and it was a lot of asset reviews and reviewing our balance sheet and seeing what was going on, and not just in my sector, but in the different sectors of Starwood. And we can get into a little bit. We are a very multi-cylinder company and have a lot of different areas that makes us a lot different than the other REITs that are out there. But the one big change that happened this time that didn't happen the last time was governmental intervention was way faster this time around than it was in 2007 and 8, right? The sleepless nights for me started being at UBS, and I can tell you the date. It was February 28th, 2017 was the first date. That's when you saw the CMBS and the TRS indexes move by 5 basis points, which is today nothing, but at the time never happened, right? We widened out, and it was, and I had seen indicative things prior to it at a company, but with the state of the leverage, especially at many different places, it was like that the thing switched off. You became, on the defensive immediately, and everything was a worry from that moment on. And yes, the CMBS market went on for another 10 months after that period, but it was the most volatile insanity that was going on. You knew that there was something that was going to happen at the end of it. So sleepless nights were long during that period, and then once with the Bear Stearns of 07, and then Lehman Brothers of 08, you were just waiting for the other shoe to drop. So it was constant issues, and I knew my life was different when I got moved out of the Manhattan office for UBS and stuck out in Jersey City. So I knew that was a moment in time where things were not going to get better very quickly. And my only goal at that moment in time was to get back to the Manhattan office. And I was like, thank God I did at some point. So that was, an important part of my career to be able to say that I got out of Jersey City. But this time around, it's different, right? You had a very sharp, quick, event. Everything widened out. Didn't widen out nearly as much as it did in 08, but it was sharp, right? But then the moment, and we can talk about this too. My nighttime job is I'm also the chairman of CREFC this year, but the other side of the job was in with Congress, in with the Fed, in with everybody at that moment in time, Mnuchin's office, trying to convince them please do what you did in 2009, but don't wait until 2 years later to pull the trigger on TALF. And thankfully, although it was limited, I'll tell you, but it did the trick, right? For a while there, we have our SMC is our lending platform for conduit lending. They were stopped because they just know what the hell was going to happen, right? And we were at that moment in time in the beginning of March about to buy a new securitization, and that deal never happened. And it was just you just didn't know. But once that. I remember the exact moment, 8:15 in the morning when that announcement came out, it was, you knew things were going to get better, and they did rapidly. And it solidified. It got you back to a point in time where it allowed the, investing community, which is totally different than it was in 2008, right? There was so much money on the sidelines here. There was so much liquidity that didn't exist back in 2008 and 2007, and there's just money to be used to go and put money out here, keeping yields kind of low. So this is a different moment in time, right? We have liquidity. People want to buy CMBS. People want to make loans. We have it didn't show up the cycles. Our SMC team pretty much got right back on the aggressive once we realized that we could do deals again. The deals have changed. We can have that conversation a little bit later, but it's not the same. We're still in business. It doesn't feel like this is the interim period between 07, 08 that the business continued going on. This feels like the concern is okay. We're there. We're different. We're going to be smaller. We're going to be slower, but we're still a viable sheet.
Now, I got a chance to listen to the Starwood earnings call the other day, Barry Sternlicht, and I should disclose that I was so impressed with his pitch that I went out and bought Starwood stock shortly thereafter, and now I'm a Starwood equity holder. I thought it was a great earnings call. I thought it really underscored your diversity as an organization, which I never really fully appreciated until I heard it verbalized that well during the call the other day. But one thing really caught my interest was he really spent a lot of time on your conduit and on the crisis, and that you were sitting on proceeds that you had lent, or you had lent out. You were kind of sitting on loans getting ready to securitize. You waited, the market recovered, and you came out pretty clean. You got great execution when you came out. Maybe a little bit of inside baseball. Was that a hard sell to kind of swallow hard and hold on to that, knowing that spreads were kind of potentially could have gone much wider, or was there a pretty good unanimity among the group that, we should wait this out?
Yeah, look, and I agree with you. I think I mentioned this to you earlier. That was my favorite earnings call I've ever been on. I'm always on the sideline there to answer questions if anything comes up, and particularly in my industry, and it was unnecessary this period, this moment in time. And Barry and Jeff DeMonica, who runs the REIT, did an amazing job really describing. Look, and we have 5 different units within Starwood Property Trust. It's the biggest one and the one that started with, and it started from exactly what this is the opposite of. There was a dearth of liquidity in commercial real estate debt lending in 2008, 2009, and Barry Sternlicht, who obviously has a reputation from his hotel universe and all this investing, started a blind pool and went out and started our lending business, and it killed it. And then bought LNR in 2013, started an equity group within the REIT in 2014, and then we started a residential lending business, which is predominantly non-QM agency, non-agency RMBS securitization business, which is just a wholly different exercise that diversifies us even more. And then in local, we bought an infrastructure lending business, in energy, which is completely different. And, for me, it's great. I get to work a lot with our CFO and kind of work amongst those different units all the time. But yeah, I mean, there was conviction. No one was panicking. Barry always says it in the history of, SMC, you only had one quarter where, things went bad, and we were right back at it the next quarter. And it's just, we're going to figure it out. The business was built to be, to handle adversity. The one rule that I think, Rich Highfield, who runs SMC, Larry Brown, his predecessor, and I, and everybody in the company always believes in is, velocity, right? If you can create a business, be able to consistently, loans into as many transactions you possibly can, make as many investment partners you possibly can in the CMBS business, it'll afford you so much, because your balance sheet will never be enormous at any one period of time. You'll always have the ability to constantly bring it down. You'll never, even if things as this did stall things for a couple of quarters, you can get right back up and keep going, because you're not at a point where the end of the world is happening to you. So that's the theory. It's worked great. We've had an amazing quarter. After having even not a terrible quarter before it. So it's it's a testament to the fortitude of obviously the people who are running the place, and and having a conviction in how we're going to keep doing things. It's a business that will go on, and and having being the B-piece buyer we buy a lot of the deals that, our SMC brethren puts the collateral in, and it affords us to see new deals, be liquid in markets, and really make sure that turnover keeps churning.
So along the same lines, when you talk about velocity, I'll ask this question on two levels. Is this a time when velocity can get even faster for Starwood? And is this an opportunity now for the CMBS market more broadly to pick up market share?
So we're in a really interesting moment in time here, right? It's actually, I think a little bit of the opposite is going on. Currently, I'd like to say that, once the vaccine, and these announcements are definitely making it easier to forecast things changing earlier in the future here. But, if you think about what a CMBS deal looked like in the first quarter of 2020, 10 to 15% hotel, 20 to 25% retail, heavy, most probably likely heaviest office, some infrastructure, some industrial and other things. And now, I don't think we're there back to that moment in time yet. We can't go and do, hotel loans like we do. And that's not because we don't want to, it's just that it's too early, right? There's not enough. I mean, if you get a property that tonned it through, the last 6 months and things like that, and you have very low leverage and reserves up the wazoo and things like that, sure, that's possible. But all investors right now is as what happened in 2010 and 11, right? As what happened when after the 1990 crisis, right? I mean, the composure of lending changed. I think that there's this data that needs to be digested by both the lending and the BPs and the investment grade units on what's happened here. Are we out of it? Look, there's more stuff that's come into special servicing in the past 6 months than it's done probably since the beginning of 2.0. We have to analyze why that happened. Just what and a lot of it it's going to be temporary, as it wasn't in 2007, 8, 9. Right, most of that stuff that came in never came back out again, unless it was in probably a sale of some kind or A/B notes or some format. This time I don't think that's the case. I think yes, there's some stuff that's going to stay, but there's going to be stuff that you're going to figure it out and try to get it out of special. Or I can tell you what one thing we definitely are doing, at LNR is we're trying to find ways to not actually even bring it into special servicing. We're trying to find ways to this is not the same crisis that we had 12 years ago. That was caused by over leverage. That was caused by, people who took out too much in loans, people gave too much out in loans, and, the whole market was just oversaturated. This is a health crisis that wasn't caused by anybody who was a borrower in this circumstance in most cases, but there was pain already in retail, and, we can have that conversation too, but the hotel industry certainly wasn't going in negative directions when this whole thing started. So, we take the stand that we're trying to do what we can to help there. Now, it's not a freebie. It's not, you come in and expect us to, just give you, 6 months of forbearance and, that's the end of it. It's a teamwork thing. You gotta, it's working with the lender, working who's now in the special, working with the master, all together, trying to figure out something that works for that property that is gonna, that makes sense for it to get a timeout of some kind or relief of some kind in the future here as we figure things out as COVID plays itself out.
Turning to the property type specific views, you talked about hotels a moment ago. We've seen record-breaking delinquency percentages, special servicing percentages, watch list percentages since March. Any green shoots there? Is there how would you talk about the vibe, if you will, of the borrower? Is there any hope right now, or are we just still in the dark days of June and July?
We did a lot of work. I mean, when I talk about all those different segments that STWD has, we moved so many people over from our investment wing in my division and from the lending divisions and from all the divisions. Frankly, had somebody who was to come in to try to help. The open fire hydrant that happened, in Illinois and special servicer, for a reason of we were getting, the master was sending, requests all the time. We were handling, individual borrowers and loan by loans. And, at the end of the day, I think there was 1,000 different requests that came through, over that period of time. And, we're, I think, the third largest special, so the others had a lot going on as well. And I will tell you, a lot of those, the borrower decided not to go forward because the cost associated for doing those things was above what they were willing to deal with. Those that really needed the help got it, and pushed things out. I think probably into the end of this year, early next year, and we have to see what's going on at that moment in time. But it wasn't as bad as it could have been. I think that the industry too. You heard from the hotel associations and things like that. I think everybody. They're just trying to talk to, the government and trying to figure out ways to try to figure out help there. And there was some in the form of, the PPP. And I think trying to get the PPP into the right places to allow the hotels to keep operating was a big part of what we were doing as well. But, the other programs didn't really work for, yet for, helping in that regard. So it took specials and masters and borrowers and others involved to try to figure out ideas. And there's a lot of it, allowing for use of reserves to help pay for, for keeping the mortgages, up to date, foregoing, tests that, would trigger, cash flow sweeps or things like that until things kind of get better. You name it, you think of ideas, those things are being bounced around the wall, and it was a creative endeavor. And I think our team, Joe Bosher runs an amazing job of, being as creative as you possibly can to try to not to, bring things into the special for everything that was out there. Some stuff had to come in because of, the way PSAs are written and things like that, but we're still trying to figure out ways to, come up to a conclusion early and not try to, keep things in special for the longest period of time. And you're seeing it, delinquency rates are dropping, stuff staying in special is dropping net, especially in hotel, I would say.
For our listeners, you've heard this before that, the forbearance term is used loosely a lot of times for the hotels. It's tapping the FF&E reserve to keep a loan current. Right. Often that is a 3-month piece of relief that's given. Sometimes there's an optionality to get a second 3 months, but at the end of that period, there's a year by which the deferred reserves have to be replenished over time. What is your gut at this point? Is there another level of relief that has to be given to these borrowers? Because it doesn't seem like, given where we are in terms of the recovery, paying back what you were paying in your P&I and replenishing FF&Es is even remotely possible at this point in the game.
TBD, I think that, we're in that lull right now in between the two things. Yeah, I think, it's like, the first wave, and I think that some of them will be okay from that first wave. I'm sure we're going to see people coming in with additional requests as needed. I think people are not shy. We're seeing, they're some of them are hiring, third-party people to help them, talk to the lender side of the equation. And yeah, a TBD, I'm not sure yet. I think certainly, it's not going to be perfect, but I can't tell you how bad it's going to be. It's really, we're in that lull.
Yeah, I guess retail is probably the same answer, right? Obviously with much more structural problems, certainly at the shopping mall level. Yeah, coming in.
I think some of that stuff was already showing wear and tear before you got to COVID, and COVID has exacerbated that issue. I think it's have and have nots. It's CMBS is generally a non-recourse business. It depends upon. I think you'll see people react to it differently depending upon how much equity they still have in their deals, how much equity they believe that they can recover once things kind of get normalized and things like that. And but we've seen a lot of surprising ones out there too. Stuff that you would have thought would have been had issues during this time. Obviously, shopping centers are doing better if you've got a grocery anchor in them at this moment in time. I think would have been anticipated with everything that's going on. I think you're still seeing that they're behaving well during this. And when things opened up over the summer into the fall, I think things normalized a lot now. But again, we're going into a period of time here. It seems like things are going to get worse, certainly east and north of where I am. And so we'll see how government reacts, and especially with the new regime that's going to be coming in 70 days, I think it is.
You're not talking about Steve Cohen becoming GM of the Mets. Is that your new regime? Is that your green shoot we're talking about?
That was the Hanukkah present for myself.
All right. Well, your wife had the foresight to want to move to Miami. So obviously a lot of New Yorkers are leaving that area. What are your thoughts about that? Is that something that you see happening?
Yeah, Barry's building the new brand new stinking office for us right across from the one hotel. We're half of it's going to be filled, I think, with new arrivals from the Great White North, as we can say from Miami, I guess. I think politically, COVID-wise, I think a lot of reasons. I think you're going to see that a lot of companies are going to wind up coming to, for tax reasons. Certainly, you're seeing it in Miami, Broward, and West Palm counties. I think we'll see a pickup in finance type of companies will show up down here. I think obviously Nashville, we'll be seeing in Austin, places which have lower tax basis kind of plays, and those places will do better in the short term. Like, look, I can tell you, let's use people compare COVID to kind of the combination of the long nature of the Great Recession along with 9/11 in some ways, the immediacy of it, and it's gonna be interesting to see really what happens to the migration of people in the United States. How many people are going to move out back into the suburbs and things like that? You may get, I know in 9/11 I lived on the Upper West Side of Manhattan, and by April of 2002 I lived in the suburbs of New Jersey for very good reasons. I didn't want to spend another day in Manhattan with my children. And that changed over time. I wound up back in Manhattan, but I could foresee that happening in a lot of places. I think, depending on how long this goes. I'll tell you, I bought a second place that has a backyard and a barbecue because I got sick of being in an apartment for X number of months. And it sounds like a lot of people did the same all across the United States. So, I expect big changes from there. Where Trepp's got a class with NYU Shack this semester that's really talking about kind of urban planning and what's happening to the cities. And, San Francisco, New York are going to have a change. And you're already seeing it retail-wise. You'll be seeing it office-wise, too, after all this, and how that's going to unfold itself. So,
I was thinking,
and your weather's better, and you got a better football team, too.
Yeah, at the moment, but, that's fickle. But, look, the weather here is... Luckily, we only had really one storm that kind of passes by, but we got our own issues. So certainly, we just had the longest hurricane season I think that's ever existed, and so there aren't that many safe places, I think, on the exterior part of our country at the moment.
I was thinking before of your effort to shake off Jersey City. I was thinking that would be a good Kurt Russell movie, Escape from Jersey City, with you writing the screenplay.
That haunts your dreams forever. Nothing wrong with Jersey City. Was lovely, by the way. I don't want to bash on Jersey City too long, but not where I really wanted my career path to be headed.
Going back to the crisis, just one last question from me, which is every crisis we've seen has kind of resulted in a change to the CMBS industry and to lending in general, right? After long-term capital and Nomura's issues, we saw people try to securitize much faster, not sit on big warehouse lines for long periods of time. After 9/11, it was terrorism insurance. After the great financial crisis, a whole host of things, risk retention being one of them, new deal structures, better lending hygiene, if you will. If you were to put on, kind of your forward-looking vision on what might come out of that, either as a lender yourself or as the head of CREFC for the year, what could you see emerging from this crisis that might make the industry stronger, more transparent, or anything in that realm?
Yeah, the thing, the big TBD from the 2.0 change that we're really going to see some interesting moments from is the operating advisor, I think, and the way you determine whether or not the operating advisor, and certainly changes of controlling class holders, is significantly different than it was during 1.0. So For those not familiar, back in 1.0, changes in control of who helps make decisions on sale of assets or the directions of what the special kind of goes through was determined by loss reduction. So if you effectuated an actual loss on a loan and reduced the balance of your lowest rated classes, you had changes of control as they kept going up the capital stack. And obviously 2007-8, there was a lot of that with, the severity of what occurred there. So people were, thought it was not the right thing to do. They thought it would be more appropriate that if there was risk already in the market, and you saw, potentially that you still may be a bond that has balance, but do you really have balance because the appraisals are showing you effectively you're out of control as is. So they changed the rule to make it based upon, appraisal reductions. And so now appraisal reductions reduce and determine who's in control, and control rights stop most of the time at the BB level, at the top of the BB level. So once you go into investment grade, there isn't really a controlling holder anymore. You have this concept of operating advisor who is there to effectively consult on the benefit of the investment grade classes. So appraisals are not a static concept. They change, and they change every time you do an appraisal. So, and different loans will not get the same timing on their appraisals depending upon when they come in and out of special. So you could have situations where you think you've changed control into a new class, and yet the next day another appraisal could potentially change you into a different class, back or forth. So there's going to be a lot of shuffling of who's going to be approving what and how it's going to affect, decisions that are made on behalf of the trust in a very much more variant manner than they were 10 years ago. So I'm wondering if that's going to be something that people are going to want to maintain once, we get through this. Obviously, as far as, changes, I'm obviously working with CREFC on trying to find ways to get money to borrowers so that they can continue paying their mortgages on time. So there's a lot of effort there. We were looking at trying to work on there's a couple of bills that are out there, one by a congressman in Texas, one by a senator, to try to change Main Street lending to afford effectively, additional debt that could be taken on, or in the form of equity, private equity. Trying to keep working on that road. So that could be a new something that didn't happen before, to trying to find money to stay in this thing to keep the ball rolling as COVID plays itself out here. Obviously, it's all going to be dependent upon when the vaccine is readily available, when people feel like they can travel again, and has the paradigm of working from the office changed permanently? I mean, I don't think so. I believe Barry and Jeff will say the same, that I think people are missing the, I'm sitting out in the hallway by my elevator in my apartment building right now. It's not the optimal work environment, I will tell you, for myself. I'm not a fan. So I speak to a lot of people, and I'll tell you a lot of them aren't the big fans of them. There are some who actually love it because they think that, it actually helps them with their work-life balance. So that whole issue, is CBD still going to be CBDs? If not, that affects a whole different, besides office, to affect all the shops that are downstairs and the places people eat and all the other things that go on with their central business district. So a lot to be determined here. And I think a lot of those things, the longer this goes, you're going to find it's going to have more and more effect on CMBS as far as what risks people are willing to take on loans in the future, how that's going to work its way through, legislation and or different things in the PSAs. And so it's, we could do this call again in 6 months and ask that question. I'll probably have a different answer for it.
On the level of appraisals, we, just like you, have seen a ton of new appraisals come through every month with the investor reporting package data from the servicers. At this point in the game, do you think the values you're seeing are reflective of the pain that's out there, not painful enough, or too painful?
I think that it's really hard to do an appraisal today because what's the comps? I mean, the comps are always really the majority part of anything you're going to look at here. And there aren't sales. I mean, sporadic ones. One you hear about one, in a blue moon somewhere, but so both ways. I don't know. I think they're just not right now. I don't think it. We're right in the middle of the significant increase in recovery here, but we don't know if it's going to last. And so anything you're seeing right now is, probably been whacked too hard, depending upon the property type it is. Certainly retail is getting the, crap kicked out of it in unbelievable ways, excuse my language. Same with a bunch of other stuff, I would say it's definitely to the worst that that people are being too conservative because they just don't have enough data to go out there, and it's going to be tough. I think we're going to, I think you'll see events of change of control that maybe are happening not necessarily because of the real risk that's associated with the loans.
So assuming we have a vaccine in the April-June timeframe next year, do you want to dare a prediction on CMBS issuance and delinquency? We won't hold you to it and you won't be graded.
April, June. Yeah. I mean, look, I think there'll be enough. If we get the feeling in the next month or two that this is a really real thing here, I think that people will kick the can a bit on what's going on right now and the loans that are out there. So I think it'll keep a massive movement into special. I think it'll allow for the time to heal. I think I think a lot of loans are already damaged, have probably shown up already. I think if we see pickup in travel, if we see especially business travel, which I think is the most essential part of this whole thing, begin to show itself up in from airplane traffic and things like that, I think we won't be certainly at 2019 levels, but I think we will be at a recovery level that people will start feeling much more comfortable about our business.
You'll be the first to know, right? You in Miami Beach, you'll be the first to know if there's more people getting off those planes and more mojitos being served. You'll drop a dime, right, and let us know that the economy is recovering and give us the heads up.
I booked a vacation for Christmas, so to give you, if I'm feeling optimistic, and it involves planning.
Excellent. Well, with that, we'll close this special podcast. Thank you to our guest, Adam. And any advice that Manus Clancy gave is not for investment purposes. It's just for conversation. So keep that in mind. Thanks to our producer, Keegan St. Ange. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Please visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.